going on, everyone? Charlie here. So you want to know why AMC and GME follow each other? Well, I'm about to explain why I think that's the case, and it's not ETFs. Let's just go with that. So hopefully you'll learn something here, and tell me what you think about it. So again, I'm not against, obviously, AMC whatsoever. This is just something I've been wanting to know all year long. I've always wondered why they move together, and I think I found the answer, or potential answer. So let's go ahead and take a look. So with market fragmentation, traders need to search for liquidity across many venues in the same country or across countries. High speed can be crucial when there is strong competition. The ability of HFTs to enter and cancel orders very rapidly makes it hard for many traders to discern where liquidity really exists, which creates more opportunities for HFTs to exploit profitable trading opportunities. While arbitrage forces should drive prices to attain an equilibrium, the exchange acting as a price leader could attract a significant portion of order flow if the adjustment takes time. In this case, it is reasonable to assume that the price discovery will tend to occur primarily in the original stock exchange of a cross-listed stock. Empirical evidence suggests that prices on Canadian and U.S. exchanges are mutually adjusting for Canadian-based cross-listed stocks. So just keep all this in mind. Now, timing. In the context of market arbitraging, timing is critical. If prices do adjust instantaneously, then it seems impossible to make abnormal profits in a consistent way, or even from current publicly available information. On the other side, if prices adjust slowly, there seems to be plenty of time for a participant or a group of participants to exploit publicly available information to make abnormal profit by trading on such information. It is interesting to notice that the delay prices need to adjust to the newly arrived information is a function of the environment, and it comes as no surprise that earlier authors considered compliant with the hypothesis' requirement that prices of individual securities adjust very rapidly to new information, which more recent studies no longer support. This is a sign of technological advance, the rationale simply being that something very rapid in 1995 did not allow the time to exploit arbitrage opportunities, whereas the same very short delay turned out to be no longer short enough 15 years later, as in Aldridge 2010. The very concept of rapidity has changed its scope a few orders of magnitude over the same period. Now, type of information. Information in the context of arbitraging could be macroeconomic news, like unemployment data, released periodically by government agencies, or change of interest rates by set monetary authorities. Other kinds of information could deal with the price of a stock which has broken a support or a resistance, or difference in price at the same time for the same security on different markets, or a temporary misalignment between stock and its related derivatives. So, arbitrage. There are three main classes of trading strategies. They are based on price, news, and arbitrage. Trading strategies based on price are typical of technical analysis. Those based on news are closer to fundamental analysis, whereas arbitrage exploits misalignment in price and can, on its turn, be subdivided into several different types. We have A, different markets arbitrage, we have B, instruments arbitrage, and we have C, related securities arbitrage. And that's where the main point of this video will be getting into, is the related securities arbitrage. So let's look at the price-based strategies. There are three main classes of trading strategies. We're going to go over the price-based one. And they are somehow related to the broad concept of technical analysis. TA assumes that prices do have memory, as shown, for example, in case of mean reversion after an exogenous shock, and therefore they do not follow a random walk. Therefore, future securities prices are, at some extent, predictable. There are numerous signals provided by TA that can be exploited to predict future stock price movements. We've all seen them. That's the main strategy that's been on YouTube all year long, or in the history of YouTube. That's the main one that you see on the mainstream is this one here. price-based strategies. Next, we have news-based strategies. Now, news-based strategy is akin to fundamental analysis, although the latter tends to have a longer time span, whereas the former exploits not only stock-related information, like periodic earnings announcements, but also a wide range of more or less indirectly linked news. This is more of an old school-based strategy. This is what a lot of the older folks like to use. It is what it is. And then last but not least, we have markets arbitrage. Now, markets arbitrage is a strategy conceived well before HFT entered the scene, but it does require fast networks to retrieve timely information about prices for the same security from different markets, and as such, it is particularly suitable to HFT speed. If and when securities price discrepancy on different markets is noticed, then the standard operations of selling the security in the highly priced market and buying the same security in the other market applies. If both legs of the trading are executed with sufficient low latency to beat on the time other investors, then a risk-free profit will be made. Now we have instrument arbitrage. We have closely related siblings in the same or in other markets. Typical examples are stock and the derivatives for the same stock. Up to a certain extent, and taking into considerations all the differences between different instruments, the prices of such securities tend to be correlated. If the spot price of a security drops, under certain conditions, it is likely that the price of the related futures follows closely. If the reason for the fall is perceived to have long-term effect, then the futures price must adapt swiftly. Otherwise, if the consensus is for a temporary effect, the operators being long on such security will hold firmly, simply waiting for the consequences of the effect to pass over. But at that point, the price will have had no reason to drop in the first place, or an arbitrage opportunity would have been created, this time on the stock rather than on the futures. And then we have related security arbitrage. Now get this shit. Now, RSA, or related securities arbitrage, is based upon observation and discovery of pairs or groups of securities that historically show similar patterns. The rationale behind such similar behavior is to be deeply investigated to ensure that a rationale does exist rather than being pure coincidence. However, once it is proven as statistically significant, then any divergence of one security with respect to the others is to be acted upon swiftly. Now, this was written in 2015, and I've kind of merged two different documents together, but this one here was basically noticing a lot of securities starting to move together, and it was hypothesizing that it could be due to arbitrage. Now, going long in the underpriced security and short in the overpriced one is a standard arbitrage technique already observed in all other types of arbitraging activities. So think about this. You have a high price stock, you have a low price stock. One is overvalued, one is undervalued. You're arbitraging between those two. That's why they always move in tandem. Now, in addition, assuming that the historical similarity tends to be complied upon again, complied upon again, the investors who have got there first will, as usual, reap all the benefits. However, it must be highlighted that this type of arbitrage is not completely risk-free, as there is no guarantee that the relationship between the two securities will reaffirm itself in the future. So, that makes the most sense out of anything I've seen. Is sure, it may be a little bit of the ETFs, but arbitrage makes more sense. The question is, which one's overpriced and which one's underpriced? I guess I'll leave the community to have that bloodbath, because you know my answer, but nothing to say anything bad against the other one. But this is the second one, the second paper. This was just written. It's called Segmented Arbitrage. I would highly recommend taking a read. Explains a lot that's going on in the market, and it's due to fragmented liquidity. So anyways, hope you found this interesting.